Hi everyone, today we are going to present our data science project on financial arbitrage, particularly focusing on the stock market. Our primary goal is to identify potential arbitrage opportunities that arise from significant events and their subsequent impact on various stocks. We've looked into diverse events that range from corporate actions, such as mergers and acquisitions or earning announcements, to broader macroeconomic events, and even unexpected happenings like natural disasters. We've meticulously analyzed historical data to construct predictive models that can flag potential arbitrage opportunities. Our hypothesis is that such significant events create predictable patterns of stock price movements that can be utilized for arbitrage. By leveraging data science and machine learning, we believe we can accurately predict these price discrepancies. Although for future real-time events, there may be unexpected or non-conforming behavior, we anticipate our model to predict a generally correct trend for each stock.
Let's talk about our methodology. Our first step was data collection, where we used the IEX Cloud API to gather data for S&P 500 stocks. This ensured broad coverage of the stock market. We scraped stock symbols from Wikipedia's list of S&P 500 companies and fetched their historical data. For each stock, we used a function named getStockData, which retrieves data, transforms it into a pandas data frame, and filters it based on our chosen dates. Then we conducted an event impact analysis, employing another function, eventStudy, which calculates the stock's beta, abnormal return, and other significant data. The results of the eventStudy are stored in a JSON file for further analysis. Once we had the data, we preprocessed it and started the modeling phase. The data was split into training and testing sets. The beta and annualized mean return values were standardized. We used linear regression for modeling and fitted the model on the training data. To validate the model, we also conducted a t-test dividing the stocks into high beta and low beta groups and assessing the significance of the difference in their mean annualized returns. We used ridge regression with tenfold cross-validation to prevent overfitting, providing a more dependable performance estimate. Lastly, we evaluated the model's performance using the root mean squared error, or RMSE, on the testing set. That sums up our methodology.
Looking at our first graph, this visualization focuses on the relationship between the beta and the annualized mean return for the stocks. It's a scatter plot with linear regression, and the highlighted areas represent a 95% confidence interval band. This graph supports our first hypothesis that a higher beta is correlated with a higher annualized mean return. We faced some challenges with this visualization, particularly with an outlier data point from First Republic Bank, which disrupted the interpretability of the graph. We decided to remove this outlier from the graph, but we're mentioning it here for transparency. Now, moving to our second graph, this visualization lists the relationships and distributions of all of our collected variables. It includes scatter plots, heat maps, and histograms to show the data distribution. The goal is to provide a comprehensive view of the data and its relationships. Choosing the types of graphs to represent the data was a bit of a challenge since our data didn't have distinct classes, but we believe that this combination provides a coherent view.
Our machine learning model aimed to predict the annualized returns of S&P 500 companies using beta and annualized risk values as predictors. Both models had some predictive power, but neither achieved incredibly high accuracy, indicating a need for further model refinements or alternative approaches. We tested 3 hypotheses using statistical methods and machine learning techniques. Hypothesis 1 suggested a significant difference in mean annualized returns between higher and lower beta companies, supporting the risk-reward paradigm. Hypothesis 2 found that U.S. presidential election did not significantly impact stock market returns. Hypothesis 3 revealed a significant difference in mean annualized returns between companies with higher and lower annualized risks, again supporting the principle of higher risk with higher returns. In conclusion, our statistical analysis supports hypothesis 1 and 3, but not hypothesis 2. Further research could benefit from increasing the sample size, including control variables, conducting a longitudinal study, and using additional statistical tests. These could help improve the accuracy of our predictions and provide a deeper understanding of the factors influencing stock returns. Overall, this concludes the presentation. Thank you for your time.